Welcome back to the deep dive. We are officially entering what's probably the most critical financial stretch of the year. Historically, these last 2 months, this is when macro events really stop just influencing markets and, well, they start dictating the direction. So today, we're doing a deep dive focused squarely on the two massive decision points set to shape your portfolio's trajectory. We've got the Federal Reserve meeting that just wrapped up today, October 29th, and then the Treasury's really critical quarterly refunding announcement, the QRA, is coming up November 3rd. Our mission really is to understand this kind of tug of war between easing policy on one side and tight liquidity on the other.
That's absolutely right. We're going beyond just the headlines here. We really need to dissect the underlying liquidity dynamics. These are the things that will either give us that fuel for a year-end surge, the Santa rally, or conversely could cause a pretty sharp near-term systemic jolt. So we'll be providing the specific inflation numbers, outlining the structural risks, and maybe most importantly, giving you those high-probability mechanical trading systems you can actually use to filter out all the noise.
Okay, perfect. Let's unpack that first pillar then, the Federal Reserve. Looking at the FedWatch tool, the data there, well, the market is clearly pricing in continued accommodation. We're seeing expectations for what, a 25 basis point cut today, a 70% chance of another one in December, and then further cuts stretching out into 2026.
Yeah, what's fascinating, I think, is understanding why the Fed feels comfortable with this path. The inflation anchor, the thing that really guides their confidence, is holding steady for now. If we look at that crucial 10-year break-even inflation rate, it's currently holding right around 2.28%.
Right, 2.28%. That's the key metric you're saying. But if inflation is still a worry, why is that specific number so significant?
It's absolutely vital. It really represents the market's expectation for inflation down the road.
Yeah.
See, when that number starts creeping up towards the 3% ceiling, that's both a psychological and, frankly, a technical level that forced that huge policy pivot back in March 2022 Brents. Well, when it gets near there, the Fed immediately slams on the brakes. Policy gets tight fast. So as long as this break-even rate kind of meanders around 2.28%, they feel they have justification, or cover, let's say, to continue easing policy. Plus, you add in the weakness we're seeing in key commodities, especially oil prices right now, that reduces the immediate sort of upstream inflationary pressure.
Okay. But this feeling of safety, it sounds like it's built on maybe some shaky reporting ground. Because of the ongoing U.S. government shutdown, we're essentially, flying blind on a major piece of data. The jobs numbers, we just don't have a clear published trend for the jobs market, right? Which forces the Fed to make these big decisions with, incomplete information. Okay, so that brings us neatly to the second equally powerful force here, liquidity, and specifically the QRA. So the Fed is easing, suggesting more money should be flowing. But you're saying the plumbing itself, the financial plumbing, might be seizing up.
Precisely, yes. The QRA, which gets announced November 3rd, that's a major inflection point because it dictates the structure of government borrowing, how much short-term versus long-term debt they issue, and that composition, it matters hugely for liquidity.
Right. The composition is everything here, short versus long-term. Can you just quickly walk us through the basic difference in market impact? If the Treasury leans into bills, that's short-term versus bonds, the longer-term stuff.
Sure. If the Treasury favors issuing short-term bills, that cash gets paid back or, refinanced much, much faster. This tends to recycle liquidity back into the commercial banking system more quickly, and that's generally seen as market positive, easier financial conditions. And the consensus is expecting the Treasury to favor bills this time around. So that's, good news for the Santa rally folks. However, and this is a big however, that expectation kind of masks a deeply concerning counter trend, something that directly impacts commercial liquidity right now. And that is, bank reserves are draining. It's a crucial chart, often ignored until, a crisis hits. But it signals tightening commercial conditions, regardless what the Fed funds rate is doing.
And it's drained. This is likely the explanation for the dollar's recent strength, right?
Yeah.
Which seems baffling otherwise. Because if the Fed is easing, the dollar should theoretically be weaker, shouldn't it?
It absolutely should be. But this drain means there's just less cash easily accessible within the commercial banking system itself. This forced tightening, sort of at the local plumbing level, it pushes up the demand for dollars, resulting in that baffling strength we've seen recently, this commercial tightening. That's the ticking clock we need to watch. It really risks causing a liquidity jolt, maybe a squeeze point, kind of like what happened back in 2018 or maybe 2019, before the Fed is, inevitably forced to step in and provide some kind of support for the financial plumbing itself.
Wow. Okay, so we have these underlying plumbing issues suggesting caution, definitely. Yet overall risk appetite seems incredibly robust still. If we gauge this using, say, the ratio of the S&P 500 relative to long-term bonds,
Mhm.
the SPY-TLT ratio, it's holding near all-time highs, which tells us money is still pouring into equities, almost ignoring these subtle structural warnings you're highlighting.
It means we have to be cautious. Yes, the market is clearly running on very strong momentum right now. And trying to front run that eventual shift, trying to pick the top, that's often portfolio suicide, frankly. So given this profound divergence between the strong risk sentiment we see in prices and the underlying liquidity weakness, relying purely on instinct here is just too risky.
That's a great point. So if the macro environment is so contradictory, you've got the Fed easing, but the plumbing is tight, how do we actually shift to trade execution? How do we filter out that kind of volatility? Let's maybe pivot from the macro analysis to mechanical execution. You mentioned the 6-week cycle methodology.
Exactly. The whole philosophy here is about clarity and automation. Your macro view, your directional bias, that should be analytical, should be reasoned based on the data we're discussing. But your actual trade execution,
Yeah.
so your entry point, your stop placement, your position sizing, that really needs to be purely mechanical. Because emotions spike when price starts moving erratically, right? And local volatility, those sharp intraday swings, they shake out otherwise good positions. This system is designed specifically to remove that emotional risk component.
Okay, so the system uses the time interval between each Federal Reserve meeting, which is roughly 6 weeks. That's the core anchor for tracking price discovery. And then we apply these modified Fibonacci levels. You mentioned 0%, 25%, 50%, 75%, and 100% of that 6-week price range. How exactly do those percentages guide the actual execution?
Right. They basically function as systematic layering points
Right.
and volatility control boundaries. So if we enter a position, let's say long, those levels act as predetermined spots where you might layer in more size or maybe take some partial profit off the table. But crucially, they guide your risk management. For example, if a position moves strongly in your favor, say up to the 75% level of the current range, the system tells you to mechanically move your stop loss up, maybe to the 25% or the 50% level. You lock in profit automatically, regardless of all the intraday noise and your gut feeling.
That makes sense. It provides structural risk management. And you mentioned there's a core empirical rule here, something that gives incredible conviction.
Yes. This is based on pretty extensive backtesting. What we found is that 90% of the time, 9-0, once an asset breaks out of its previous 6-week cycles range, let's say it moves definitively above the 100% boundary of the last cycle, it will not trade back down to the opposite extreme, so the 0% boundary, during the current 6-week cycle. Now that 90% figure, that's profound. It works, we think, because institutions commit pretty heavily once a cycle clearly confirms the breakout direction. This creates a very strong momentum bias that typically persists for, well, the full 6 weeks or so. And this allows you, as a trader, to manage your risk much more aggressively and, frankly, with very high confidence once that breakout is confirmed.
Okay, that's powerful. Let's move to some specific market setups then, informed by this analysis. Starting with foreign exchange or FX, you highlighted two key high probability setups. The first one being the AUD-NZD cross pair, the Aussie versus the Kiwi dollar, approaching that critical 1.15 level.
Yeah, we often call this the unspoken peg. It's not official, but for well over a decade now, that 1.15 level has acted as a pretty solid historical cap. And the opposite extreme, down around 1.02, that's acted as the floor. This strongly suggests, though never explicitly stated, that central bank intervention likely occurs at these extremes. Why? To maintain trade stability. And this stability is incredibly important, especially for New Zealand, which relies so heavily on its dairy and meat exports to Australia. So our anticipated setup here is actually a short opportunity, betting against further significant upside, especially if we see maybe a temporary quick stab above 1.15 that then fails.
Interesting. But there is that geopolitical factor pushing the Aussie higher right now, isn't there? The market seems to view Australia as the clear winner, or at least the key alternative supplier in this whole rare earth minerals trade spat with China. That's a fundamental pressure fighting against that technical resistance level, right?
It absolutely is. And that's why we wait for the setup, the price action confirmation, rather than just shorting at the level blindly. You need that confluence.
Okay, got it. Now, the second critical FX setup, USD JPY dollar yen. You mentioned a massive technical opportunity there based on a pricing gap that exists between 147.33 and 149.
Yes, this is a signal we absolutely must respect. Look, Gaps in major foreign exchange pairs, unlike maybe in equities, they have this empirically proven very high tendency to close, something like 95% of the time. They essentially represent a significant pricing inefficiency or maybe an arbitrage opportunity waiting to happen. And crucially, the way this specific gap closes, that event will likely signal the next major macro trend for the entire market, not just FX.
Okay, walk us through the two main possibilities then for how that gap closure might play out.
All right, so that gap, it pretty much has to close via one of two major market events. Scenario one, we get a massive dollar dump. This would likely be triggered by a significant, maybe unexpected Fed liquidity injection or even outright QE, something that rapidly devalues the dollar across the board. In that case, you'd see pairs like USD, RUSD probably surge higher as USD JPY falls to close the gap. Okay, scenario two, a major risk-off event. This is more like a global contraction, something that crushes equities, probably hits crypto hard too, and causes a sudden massive surge of safe haven money pouring into the Japanese yen, pushing the yen parabolically higher, which again closes that USD JPY gap from the other direction. So we monitor the structure, we watch the price action, and we wait for confirmation of which scenario is actually playing out before committing capital.
Fascinating. Okay, let's turn quickly to crypto market health. You mentioned using dominance charts, specifically stablecoin dominance. What does that tell us right now?
Yeah, stablecoin dominance spiking, like it has been recently, it basically means that capital is parked on the sidelines. It's held in cash equivalents like USDC or Tether, waiting for direction or maybe better entry points. The current high level suggests we are likely sitting in what you might call a discount zone for many altcoins. The expectation is that eventually this money will flow out of stablecoins and back into risk assets like Bitcoin, Ethereum, and other alts.
But the near-term outlook, you said, seems to be kind of faltering a bit.
Exactly. That's the wrinkle right now. The conviction that the $3,500 flash crash level we saw a few weeks back in Ethereum, the conviction that that marked the structural bottom, well, that confidence has plummeted. It went from maybe 90% certainty among analysts down to now less than 50%. The follow-through liquidity, the buying pressure needed to push altcoins decisively higher from here is just failing to materialize right now. And what that suggests, unfortunately, is that another dip, or at least a more bearish reaction, is probably anticipated in the near term. This could potentially push that final altcoin bottom consolidation phase more towards that November-December timeframe we previously forecasted.
Okay, good to know. And just a quick overview on the major indices, S&P 500, NASDAQ.
Right, well, they're riding very strong momentum, as we discussed, hitting all-time highs, which is obviously great if you're already holding positions. But for initiating new long positions right now, the entry levels are generally pretty terrible from a risk-reward standpoint. They're quite extended.
And you also noted a worrying divergence over in Europe.
Yes, in Germany specifically. The main German index, the DAX, is also near all-time highs, looks strong on the surface. But its key component, the massive German enterprise software company SAP is lagging significantly behind. Now, we watch SAP quite closely because it also provides a pretty direct window into global corporate spending intentions. Software spending is a leading indicator. Its lag right now suggests there might be some underlying instability beneath the surface of that DAX rally, especially given the, broader slowing we're seeing in the German economy.
And finally, oil. You mentioned crude oil.
Yeah, the technical outlook for crude is actually pointing higher right now. It's trading around $60.45 as we speak. The setup looks like it's building for a potential breakout toward maybe the $66 level.
Which is kind of bizarre, isn't it, given the weak commodity landscape you mentioned earlier?
It is a bit bizarre, yes. And it implies, maybe worryingly, that inflation could pick up again down the line. That would certainly create a fresh problem for the Fed, probably next year. But for now, the primary mechanical entry setup we see is potentially a buy on a dip, maybe looking for support around the $58.50 level. So, okay, just to summarize the really essential decision points that are defining the market for you right now. First, watch the outcome of the QRA on November 3rd. Is it bills or is it bonds? That sets the liquidity tone. Second, watch for the eventual closing of that huge USD JPY gap between a 147.33 and 149. How it closes tells you the macro regime. Those are really the two big macro indicators that will define the year-end trajectory.
Right. And understanding the mechanics, like using that 6-week cycle system we talked about, allows you to capitalize quickly and maybe more importantly, efficiently. Once that macro decision is at the dollar dump scenario or the global risk-off event, once that becomes clear in the price action. So manage your risk mechanically and wait for the signal. Don't jump the gun. But let's leave you with this final thought, something that kind of ties all these threads together. The immediate structural threat we identified earlier is that drain in bank reserves. That could lead to a potential near-term liquidity jolt, right? So here's the question. If the Fed recognizes this threat, maybe sooner than the market expects, and feels forced to intervene early to prevent some kind of financial plumbing failure, does that surprise liquidity injection happen before the QRA results are even announced on November 3rd? And if it does, how does that unexpected early rush of cash completely rewrite the script for that anticipated Santa rally? Does it front-run it? Does it negate the QRA's importance? What stands out to you, listening right now, as the immediate signal, the canary in the coal mine, to watch for in the coming days?